Okay, it's 7 o'clock. Welcome to this Milton Keynes branch event online on corporation tax. I'm going to introduce you now to Mark Wallace, who is from Walter Wright, who will be delivering this session on corporation tax. So let's just make you the host and, oh, no. Okay, Mark, away you go.
Okay, thank you very much, Chris. If everybody could just bear with me one moment while I just share my screen so you can see the slides. That would be very helpful. Okay, could somebody please just put a thumbs up or just to let me know they can see my slides, please? Or put something in the chat. Okay, thank you very, very much for that. So as I've already been introduced, I'm Mark Wallace. I'm a tax partner in the accountancy firm Walter Wright. We're a practice based down in Suffolk. We've got 20 staff, and I head the firm's tax team. And as a tax team department, we deal with many areas of tax, right from corporation tax, stamp duty. As I often say to people, stamp duty is becoming a particularly a topical topic at the moment. And also personal tax and so on. So this evening I've been asked to talk to you about corporation tax, and I'm going to, what I decided was I'd pick out 4 key areas where we're having discussions in the office. For some of you on this call, you may be fully aware of them, and hopefully it'll be a useful refresher of some of the issues that arise. For other people, it may be that you've come across for the first time. As we go along, please feel free to put your comments in the chat or the question. I'm just checking actually. Yeah, so either in the chat or the question and answer box, and I will try and answer any questions as we go along. So please feel free to interject. Also, I will be taking a break for 5 minutes. I'm always conscious of how on these seminars, spending a solid hour or so on a call can sometimes make you feel a bit tired. So I will be taking a 5-minute break, depending upon timing. So the 4 key topics I want to cover this evening are the topics of associated companies, loan relationships, a little bit about raising finance and the difference between loans and equity. And then in the final sort of section, I want to talk about company losses and a general update of some topical areas that we are having. Okay, I can see Sandra is asking, will we be sending the notes, please? The chat is disabled, so my apologies. Yes, please put it in the question and answer box. I'm sure that Chris will send out a copy of the notes after the session has finished. If not, if you drop Chris an email, I'm not sure I can arrange it for you. Okay, so moving to the first topic, associated companies. I just wanted to start back at the basics and explain a couple of concepts. So who is subject to corporation tax? And if I was to ask anybody in the average accountancy practice, who is subject to corporation tax? I think most people would come back, well, we know by definition it is corporates, limited companies. But the Corporation Taxes Act actually goes further than that. What the Corporation Taxes Act says is that the corporation tax is subject, it applies to any body corporate or unincorporated association. And I think it's key to just remember that final part, unincorporated association. For example, if you have an LLP, most LLPs have a business or a trade, but you can have cases where an LLP comes to the end of its life, or sometimes the beginning of its life, where it might be doing, investing in things. In some cases, that means the LLP would be subject to corporation tax. Another sort of area that's often overlooked is clubs, societies, your typical sports club. If that makes a profit and is generating income, then that income in some circumstances can be subject to corporation tax. Now, one thing just to be aware of is obviously there's lots of release that apply. So don't go out tomorrow and say that every sports club is subject to corporation tax. Some of them exist in the life of charities. But corporation tax actually is wider than just limited companies. Will this apply to council bodies? I think the answer to that question is it depends on the council body. Councils themselves are not subject to taxation, because if you think about it, they raise taxes from us, and it'd be unfair to levy taxes on taxes. However, you can have cases which are seen where a local authority sets up a entity underneath it to carry out a particular activity, and in that case it can sometimes be that separate entity is subject to corporation tax. The key message I want to get away is from this particular part is just remember that anybody generating income is either subject to income tax, and income tax broadly is individuals, persons, partnerships. If not, then corporation tax can come into fray. Charities, for example, are subject to corporation tax. That's the starting point. But then the Corporation Tax Act says, but if they generate income for the purposes of a charitable purpose, then that is exempt within certain limits. The topic of charities goes way beyond this evening, but just be aware of that. It's well known now that the corporation tax rate is going to increase, or has increased, to 25%. It was very much of a bit of the hokey cokey. We had Rishi in the budget of 2021 saying that the corporation tax would increase to 25%. Then, of course, we had Liz Truss and her mini empire saying that they were going to scrap it altogether. What they then went on to say was that they would introduce a taper above £50,000, so that businesses only start paying the full rate on profits from £250,000 in total. And the statistic is that only 10% of companies will pay the full rate. I have to say, I do treat that particular statistic with a little bit of pinch of salt. Looking across our practice, certainly more than 10% of our companies will pay the full 25% tax rate. When this was in the past, when before the corporation tax got lowered to 19%, this wasn't so much of an issue. You didn't start paying the higher rate of tax until you had profits of about 1.5 million. Even after this, it's just to remember that we do still have one of the lowest corporation tax rates in the G7. Lower than the US, Canada, Italy, Japan, Germany, and France. But it's certainly going to hit a number of clients. I've been having discussions with clients over the last 6 months or so, where I've been saying, look, this is the corporation tax you're paying now. This is the corporation tax you'll be paying come April when the rate increases. So what happens? Well, up to £50,000 worth of profits, you pay tax at 19%. And then above £250,000, you pay profits at the tax at a rate of 25%. But it's the middle bracket between 50,000 and £250,000 that you have a little bit of a surprising effect, because the way that the legislation works is you start off at 50,000 paying 19%. At 25% you pay £250,000. Sorry, above £250,000 you pay corporation tax at a rate of 25%. But that applies to the whole of your profits. So what it means in effect is that between 50,000 and 250,000, there is a marginal tax rate of 26.5%. Now, when you're planning with companies, just bear that in mind. That the minute they exceed that £50,000 threshold, for every pound they earn, 26.5% will be going away in corporation tax. And that, when you're talking about companies about planning, spending money on expenditure, etc., on plant and equipment, just bear that in mind. Or if you've got companies in a group or connected to each other, again, just bear that in mind, that when you're planning it, just look carefully. I mean, I've got a client at the moment where one company is a very small company and generally just breaks even. The other company is the bigger company, and that is where all the profits are. Well, In that case, as we'll come on to see in a minute, the limits are divided by 2. So one company will be paying 19%, the other tax will be paying 25% at the full rate. So I've just sort of set out a sort of a graph to sort of illustrate that. As you can see, the blue line is the profits that you would be paying up to April 23. And then the orange line or grey line, depending upon the colour of your monitor, shows the corporation tax that you'll be paying if you are from April 23. And as you can see, below £50,000, there's no change. It's when you get above that, there starts to be a difference there. So, you know, profits of £250,000 or above at 19%, the amount of tax payable is just under £50,000 and just over £60,000 at a rate of 25%. What does it mean in terms of the overall tax rate that you pay? Now, I noticed when I was looking at the slides this evening that actually the scale has actually moved slightly, so I do apologise. What it's supposed to show is that at £50,000 of worth of profits, you're paying tax on 19%. And then as it goes up, you pay tax at 25%. And as you can see, the amount of the percentage rate goes up almost in a straight line. Again, yes, in terms of notes, we just had another delegate ask, will be any notes available records for catch up again? Yes, there will be notes available at the end. So associated companies, what is the issue? Well, it doesn't take a rocket scientist to work out that if you've got a situation where you pay tax at 19% on profits up to £50,000, and then the amount of tax you increases goes up, then what you could do if you were somebody who was concerned enough about it is split your companies into different bits. If we go back into the 1980s, there were cases where some of the banks, and it was slightly for different reasons, admittedly, because they were leasing, but they would actually have a company for every day of the week. And sometimes for every day of the year, 365 companies divide the profits, and all of a sudden your corporation tax rate goes down. So we have the associated companies regime being reintroduced. Now, for those of us who were dealing with tax in April 2015, there was a little bit of rejoicing because the associated companies regime was scrapped. Why was it scrapped? Well, that was when the 19% rate of corporation tax was brought in. And then we had the concept of 51% group companies. Now, the reason why the 51% group companies was important was, and something that is often forgotten, is that if you have a large company, you're supposed to be paying your corporation tax on a quarterly basis rather than the one payment 9 months after the end of the accounting period. Now, at the moment, that applies to a company who's making profits of 1.5 million or above. If you make profits below that, then you do not pay quarterly instalments. But again, what you could do if you had a group was have a number of companies and try and split it. So what we had up to March 23 was the concept of a 51% group company, and you divide your limits by the number of 51% group companies, which would seem to be a fairly simple way to go about it, and which was what it was intended to be. So if you had 2 limited companies, you'd pay quarterly instalments if your profits were £750,000 or above, and so on, so forth. However, with the reintroduction of the various tax rates, we've gone back to April 15 and reintroduced associated companies. At the time, there was a lot of discussion in the tax world about how complicated the rules were, how unfair the rules were. And I often find it interesting in the tax legislation that very often you find things, we see this with entrepreneurs relief, business asset disposal relief as it's now called. That was a reintroduction of the retirement relief rules. Again, it seems that what the draftsmen will go out to say, okay, we've got a problem, let's see what there was in the past and forget all about all the problems that we had in the past. So from the 1st of April 2023, we have the concept of associated companies. HMRC have recently reintroduced a set of new forms CT600. I know that some of the software companies have already introduced those new forms. Our practice uses RS practice software, and that was included in the update that came out a few days ago. PTP, I know, have also updated their software. It's probably not too much of an issue at the moment, but just make sure that if you file any accounts where the accounting period finishes after the 31st of March 23, that you've updated your software so you use the new corporation tax form. And on that form, you'll have to show the number of associated companies. So let's just use a simple example. In a group, in this very simple example, you've got X Limited and Y Limited. X Limited owns more than 50% of the shares of Y Limited. There is in this group 2 associated companies. A very, very simple sort of way of looking at it. That means that X Limited would start paying the higher rates of tax if their profits were £250,000, sorry, £25,000 or more, and Y Limited would do exactly the same. Let's look at another example. Let's look at the example here, where we've got a group where there's 3 group companies. Now X Limited owns 51% of Y Limited, and Y Limited owns 51% of X Limited. So starting at the bottom, who controls Z? Well, Y does. Who controls Y? X. So what we have in this case is we have 3 associated companies. And it's important to remember that in groups, you have to always ask yourself the question, who ultimately controls the company? And you look at it in terms of the number of companies in that control group, if that makes sense. So the shareholders of X would be able to control what goes on Y, and also control what goes on in X. What you don't do, what some people might do in this example, and say, well, Y Limited is 51% of has 51% of XZ Limited, and X Limited therefore must have a smaller percentage of Z. Now you look at who controls that and that company. So in groups, you look at control and you try and find out the group of companies in that case that controls it. Okay, so that's groups. In some ways, it's fairly straightforward. You just need to know what's happening. Now, one thing to be aware of is that the number of associated companies applies to the number of companies across the world. We have cases in our practice where we deal with 2 limited companies. They are UK based. And it would be tempting to say, therefore, there's only 2 associated companies. But we know that within the group, there's countless numbers of companies. You know, I think there's about 20 in the States, for example, and across the world. And so what you have to do is you must drill down and find out what the entire group structure is. What's also important, and also that's important from your money laundering situation, where we're supposed these days to find out who controls the company with the register at Companies House is correct and so on. But you know, just be aware when you're planning, when you're preparing computations of what is in the group. Okay. We've been asked, are they associated simply by shareholding, regardless if they have any dependence on each other? When it comes to group companies, as a general rule, you look at, and we'll come on to what control means in a minute, but it can be controlling by shareholding, controlling by votes, or even controlling by a limited company. Now, so we'll come into that on a future slide in a minute. So that's groups and companies. Therefore, I'm just going to close off some of the questions so that it's done. Okay. Okay. Otherwise, I have a little thing flashing in the corner of my screen saying there's questions to be answered. So we've talked about groups. Now let's talk about individuals. Now, I make no apologies for the fact that I've nicked this example. So if you go, if you really want to be bored, you can find out where I've nicked this example from. It does the rounds in certain places. So let's look at the example of 2 companies. They're not in a group, but they've got individual shareholders. Now, what you'll have to do is you have to find out what they call the minimum control holding, and then see if there's any other similar things. So it's probably easier in this example if we start with Green Lane Limited over on the right-hand side. If we look at Green Lane Limited, you'd be tempted to say that that company is not controlled by anybody. Alan has 30%, Beth has 30%, and Chris has 40%. So it'd be very tempting to just look at that, Green Lane and say, actually, there's no control. Nobody controls it. And I'd say, yes, that's true. But what the legislation requires you to do is go a bit further and say, what's the minimum control holding? Now, in this case, there's several combinations you can look at. So Alan and Beth together have 60% of the votes. Beth and Chris together, they have 70% of the votes. Alan and Chris, they have 70% of the votes. So already we've come to 3 combinations. So Alan and Beth, Alan, Chris, and Beth and Chris. And what that means, therefore, is we then have to look at other companies. So if we then look at Blue Bank Limited is 50% controlled by Alan and 50% controlled by Beth. Now, what it means in this example is that Blue Bank and Green Lane are therefore associated because you've got 2 groups of people controlling the same in the same control group. Now, it may be that you could go off and you could see that perhaps Chris and Beth between them have also got another company. And if that's the case, then again, that would bring another associated companies into that group. So what you're required to do is to find out what the minimum control holding is. In the example, are Alan and Beth a married couple? The answer is, in my example here, no, they're not. However, we'll talk about married couples in a moment because that's where it gets interesting. So, hopefully you've got the concept. You look at each company shareholding and says, who controls it? And if not one person, then you look at the combination, and then you look at the other companies controlled it. And this is where it gets difficult. If we go back to what I was saying earlier on about the concept of 51% group companies, that was easy because you could look at a group and you could say, well, company A has this and company B has that, and you could get a good structure. When it comes to the associated companies regime for individuals, you need to do a bit more digging around. You need to perhaps talk to some of the clients and saying, okay, Alan, what other companies are you involved in? And then find out whether or not there's similarities and do a bit of digging around in order to work out the number of associated companies. So as I say, the number of associated companies here, they are associated with each other, and you therefore split the limits between 2. Okay, so what about if you have married couples? What about, for example, if you had the example of Alan controlling 100% of Blue Bank Limited and Beth controlling 100% of Green Lane Limited? Would they be associated? Well, if Alan and Beth were married, the question would be, it all depends. Is there what is called substantial commercial interdependence? These are tests that were actually introduced in order to stop anti-avoidance, people moving creating multiple companies. Me, for example, I've got a lad who's 21 years old, and I could say, well, actually, I'll tell you what, you can create a company, and therefore we'll get around it this way. Well, if those companies have any commercial dependence in each other, then you have to bring those companies into a group if they're held by family members. So what do we mean by commercial interdependence? Well, you look at 3 things, and it's an OR test. So firstly, you ask, are these companies financially interdependent? So for example, it could be that one company's lent money to another. It could be perhaps the borrowings have been guaranteed by another, or perhaps they have a financial interest in the same business. Are they economically interdependent? Do they both share the same objectives? For example, do they have customers in common? Do they have suppliers in common? You know, do they depend? You know, if you took one company away, would they be affected? Or the other one, which is particularly of note, is are they organisationally independent? So, for example, if my wife ran a company and I ran a company, and we shared the same management or the same premises, you know, for example, if we traded from, I'm talking this evening from our house, if we were both operating from the same, same house, so we share the premises, then there would be organisationally independent. So you look at these three tests. Now, if you look at those three tests, what you then do have to say is, well, are these companies controlled by associated members? So are these companies controlled by anybody in the close family? And by close family, they I always think it's actually rather badly named, because it's close company in the legislation. Close family says it's a spouse or civil partner. You say fair enough. A parent or a child, that's fair enough. But then you look even further. You know, your grandfather, your grandchildren, your great grandchildren, and so on. Your brother or your sister. Business partners, if any of our business partners have a controller business, again, they would be associated. And also, again, I won't talk too much about trusts this evening, although I'm a fan of them. But in some situations, trusts and settlements can mean that you are associates, and therefore your companies are therefore brought together into together. So I hope that sort of answers the question earlier on about marriage. You know, if somebody's married, you wouldn't normally say, well, if my wife controls a company and I control a company, they're associated. The starting point would be, well, are they actually linked? Do they trade together? Do they share premises? Do they, do they have the same objectives? And if they are, then they would be associated companies. What they're trying to do is they're trying to make sure that they only catch people who are splitting the trade or a situation, but obviously, as you can see, the rules could sometimes go further than that. So what do we mean by control? Going back to earlier on to the person who asked, was I looking at shareholdings? Well, control, you look at four different things, and it's any one of them. So to start off with, the easy one, do you have a greater part of the share capital of the company? So you can quite easily do that. You can look at the share register and say XYZ has 50 shares in this company, and there's 60 shares, for example. In that case, they control it. What about if there's voting rights? Now, some think that there was various court cases on in the distant past was what about voting rights? So sometimes, for example, there might be something in the company's articles of association that says that if you've got two shareholders and it's a vote each, then ultimately there is no control. But what the articles of association sometimes say, but the chairman of the meeting is the one with a casting vote. And so in some situations, it's not every situation, really, but some situations, the person with the casting vote would actually end up having the voting power, and therefore would be the person deemed to control the company. And then the third bullet point, which I will read out, so much of the issued share capital of the company that would entitle him, and I apologise that the legislation is very sexist. It still talks about him as opposed to hers or person, on the assumption that the whole of the income of the company were distributed among the participators, that's the shareholders, to receive the greater part of the amounts they distributed. So what it says is that if you looked at the rights of the shares in terms of income, and it was all distributed, who would be entitled to have the larger share of it? And again, if it was 50% or more, then you control. And then the other thing, the fourth bullet point, such rights as would, in the event of the winding up the company or other circumstances, entitle him to receive the greater part of the assets then available for distributing on the participators. Now, on the face of it, you'd think, well, that's simple. What you look at is the number of shares you own and the percentages there. But consider this, I'm a shareholder in a company, and I actually own, just say, 25% of the shares of the company. But I've lent the company a large debt. And that means that if the company was wound up, I would receive the repayment of my loan, and then perhaps my shares being repaid thereafter. Now, what that means is that because I would receive the loan capital first, and that would be the largest payment. It may be actually, if the company was trading in a bad way, I would be the only person that would receive the money, that I would be deemed for the purposes of this legislation to control the company. So you don't just look at the number of shares, you don't look at the voting power, you don't just look at the amount that you get if you wound up the share capital. What you do is you also look at the amount that you receive in terms of a winding up, the loan capital. And that's sometimes the fourth point that people forget, because sometimes you can have a shareholder who may not control it, but may actually control it in terms of, in terms of the loan capital, therefore. So when you look at controlling, you look, I would normally start off with the shares and the voting rights, but don't forget about the other parts of this, the legislation as well. Because it can mean that different people control the business depending upon which of those 4 tests you use. And you need to sort of apply all 4 tests in all the situations. Other companies that you can ignore. Well, you can ignore a company if it hasn't traded and hasn't had a business during the period. So this deals with dormant companies. So if a company is dormant, you can ignore it for the purposes of counting on a certain number of associated companies, which I think you'd accept is fair. Holding companies can, though, cause a little bit of an issue. A holding company, normally the company at the top of a group, can be ignored if it has no trade, and if it has one or more 51% subsidiaries, which you'd expect, and if it's what's called a passive holding company. Now, before I talk about a passive holding company, I would just say the holding company is ignored if there is no trade. I've seen over the last few years a move to holding companies having, let's say, for example, the rental property up the top, as well as the trading company. The trading company held as a subsidiary. Yes, it simplifies things because it means that you have the property separated out. But just remember that then means that you will lose the ability to ignore it for the purposes of the associated companies regime. So if that property was not sitting in the holding company, then you would not be able, if it wasn't in the holding company, then you'd be able to discount the holding company for the purposes of associated companies. But if it has the trade or the property, a trade or property sitting in the holding company, then that holding company would be counted and you'd end up dividing the rates by the number of associated companies. And that can actually have some surprising effects if you work the maths through. So what is a passive holding company? Well, a passive holding company is a company, as already said, that has a subsidiary. You'd expect that to be the case. Is that a passive holding company is one that's not entitled to deductions by way of donations or management expenses. Again, that's insensible. And no income or gains other than dividends that are distributed in full on shareholders. So what the concept is that if you've got subsidiaries at the bottom paying dividends, you'd expect the holding company to pay those dividends up to the shareholders. Now, interestingly, there's nothing in the legislation that says how quickly that has to be paid up. I always say to clients, play safe, make sure that you at the end of the year, that holding company is not holding on to any undistributed dividends that is distributed up to shareholders. Make sure that there's no assets sitting in that company, and then you can discount it from counting on the number of associated companies. Now, that's as much as I want to talk about associated companies tonight. I will just very quickly pause to see, and I can't see there's any questions. If you've got any questions on that subject before we move on, if you'd like to just put your type it away in the box. I've either baffled everybody with science or I've made it clear, one of the two. I'm quite willing to take questions afterwards, or as if something occurs to you as we go along. Okay, so the second point, loan relationships. What is a loan relationship? Now, I've copied this straight from HMRC's manual because this is what they will quote back to you. A loan relationship exists if a company stands in the position of a creditor or a debtor, i.e. they're a lender or a borrower, in respect of a money debt which arises from the lending of money. I've just been asked, if you have a subsidiary companies overseas, does this impact UK corporation tax? The answer to that question is yes, it does when you're counting the number of associated companies, because that overseas subsidiary would be included as an associated company. That subsidiary wouldn't pay tax in the UK unless, of course, it was a company that was resident in the UK. But if you've got a typical set up where the company is incorporated abroad, it's controlled abroad, then trades abroad, then they would pay tax in that foreign country. But in terms of the associated companies, yes, it would be counted in the number of companies. Okay, just jumping back, right, so going back to loan relationships. A loan relationship exists. So basically you've got one company that lends and one company that's obviously borrowed money, and it arises from the lending of money. So that's what a loan relationship is. But also then the legislation widens loan relationships further. I haven't listed them all out, but the common one is trade debts. Debtors, debtors book, sales ledger, that's a loan relationship. Debts arising from the sale of assets. So if you sell an asset and it's not paid for, again, that's a loan relationship. Finance leases, hire purchase agreements, they are covered by the loan relationship regime, and balances outstanding on intercompany accounts. I've used the word certain balances just to cover off anybody who might have some real obscure examples, but generally an intercompany account would be subject to the loan relationship regime. Also, it's the legislation brings in arrangements that disguise a return that looks like interest. You see these in tax avoidance cases where perhaps you have a loan that's issued and it's repayable a much higher figure, might say RPI plus 5%. Well, that's regarded as disguised interest. That's really hard. Shares held by a creditor, which are accounted for as liabilities by the debtor. You don't see that very often, but you can see that on occasions. Including loan relationships is the alternative finance, basically Islamic finance, and also sales and repurchase arrangements, repos on the market. So the loan relationship regime is fairly wide. So what's the key principles? Well, the key principle is that if you're drawing up accounts in accordance with UK GAAP, and let's face it, if you're filing at Companies House, you should be, then all profits on loan relationships will be charged to corporation tax as they arise. So you don't worry about, is it the interest paid or unpaid? For example, you might be quite au fait as an individual. You only pay income tax on interest as it is paid to you. When it comes to limited companies, the concept is, as a general rule, that the interest is payable based upon when you accrue it in the accounts. That can sometimes be something that you just need to be aware of, because you may have cases where you accrue the interest, but it's not paid out to another company for a number of years. If it's between companies, then that interest is subject to tax when it's accrued in the accounts. So the computation follows the accounts, and there's no distinction between capital and revenue. So what the legislation actually says is that if you capitalize interest, so for example, you might see it where if you're building a building, the interest is capitalized. Again, that interest is relieved when you write it off in the accounts. There's always relief for it, or it's always taxed. Again, as I say, there's important to try and get the definitions right. So a creditor relationship is where a company is a lender. It can sometimes be, when you read the legislation, HMRC guidance, a bit counterintuitive that I would say a lender is the person who owes, who's lent the money. Well, the lender is the creditor. Where a company is a creditor, that's the lender. Where a company is a debtor, that debtor relationship is a borrower, is a debtor relationship, but the person who's the borrower. So the key purposes of the trading profit and losses, if it arises during the normal part of a business, then it's taxed in the normal way. You don't need to do anything on your corporation tax computation. You make no changes. However, if the interest or the loan write-off arises due to non-trading purposes, then you have to add it back. It's not deductible against your trading profits. So you can have a case where, for example, I've got a client where they have a large loan. That loan was raised in order to finance the purchase of a property for rental. In that case, on my computation, I'd start off my profits per accounts and add back things like entertaining, etc. But I'd also add back the interest. And so there'd be no relief against trading profits for non-trading loan relationships. What you do is you then pool all the loan, the non-trading aspects together. So what you'd say, okay, I've paid interest on a loan. Therefore, if it's to purchase a property, that's a non-trading loan. So that would be a non-trading loan deficit. Maybe you borrow, a bank has paid you interest on a bank account, which is probably more common these days. That would be a non-trading receipt, and you'd net the two off to have a non-trading profit or a non-trading loan relationship loss. Again, it's important to remember that when it comes to the properties, if a limited company has a property, the rental income is taxable as property income. However, the borrowings to borrow that is non-trading and is in a separate pool altogether. As I say, it's not just interest. The legislation talks about covering things like charges, setup fees, bridging a loan relationship, arrangement fees. It talks about entering into or giving effect for a related transaction. I'd say that's the broker fees, making a payment underneath a loan relationship. So, for example, if there's early redemption on a mortgage, those fees are allowable underneath the loan relationship regime. As I say, it's based upon when you're actually offsetting it in the accounts. Solicitor's fees. So if your solicitor charges you for setting up the loan, those expenses are allowable underneath the loan relationship regime. There's also a bit that says attempting to bring a loan relationship to existence. What does that mean? Well, effectively, you might be going for a loan and actually you find that actually it's not successful. That would be allowable underneath the loan relationship regime. But, and there's an important thing, it's not always as simple as that, because if you have a company that's connected underneath common control, then there's a special regime. What applies in that case, as we say, is that special rules, I'll come on to them, so my slides are slightly different order, so I apologise. Now, normally, as I say, basically you follow the accounts. So if you had an unconnected company situation and the debt was written off in the accounts, I think we'd all agree you'd have a credit, you show a profit because the loan's been written off. Now, if you think about it, that would be fair because the company at the other side would be making a loss on that loan, so therefore would be claiming tax relief on it. But there are three key areas in the legislation that says that write-off is not subject to tax. And that's if it's part of a statutory insolvency arrangement. It's if there's shares being issued in place of the debt, or if the debtor company is writing off the debt because of the insolvency conditions, which basically says that if the debt was not written off, then it wouldn't be able to trade in the next 12 months. So if that's the situation, you need to watch out that the credit, the right back of the loan, if that makes sense, would not be subject to corporation tax. It doesn't prevent the other company necessarily claiming the loss on it. It just means that the tax, the credit is not subject to tax. Also, just something to be aware of is loans to participators. Now, what I'm talking about here is, for example, I may have shares in a company and therefore I am a participator. And that company, I owe money to that company. Maybe that I've borrowed money from that company. And therefore, I can't repay that money to the company. Now, if you think about it, the company would write it off. Is that going to be subject to tax? In fact, I'll have a quick part first. Perhaps you could just sort of quickly in the question answer thing, a couple of people put what their thoughts. Would that be subject to tax? If a company lent me money as a shareholder, would that be subject to tax? Okay, I'm going to say that everybody's either asleep or they're ahead of me. So the answer to that is no. Hello, right, I've got somebody there. Yes, that would be subject to tax relief. Okay, well, okay. There's also no, which is always hedging your bets. So, well, the answer to that question is it depends. So, if a company lends me money and I don't repay that money, and the only reason the money has been lent to me is in the capacity, is written off, is the capacity of a shareholder of the company, then the company would not be able to claim tax relief for writing off that debt because it's a shareholder loan. Now, the reason for that is because if you think about it, I, as a shareholder, have made a profit from that debt being written off. And what the legislation says is that in that situation, the loan write-off is taxed on me as a dividend. So if there was a £10,000 loan I borrowed from the company writes off, therefore I would be deemed, for tax purposes, to receive a £10,000 dividend. So the answer is that would not be subject to tax in my hands in terms of any other way apart from tax as a dividend. However, a company does not claim tax relief for dividends, and that means it could not claim tax relief if that loan was been written off. However, as I put on the slide, notes that directors and employees may not be covered by this. Now, this is an area which quite often we see in practice. So a director borrows money from the company and does not repay that. What happens in that case? If that happens the case, and the revenue will always go for it and say, well, if the director stroke employee has a loan and it's written off by the company can actually claim tax relief for it. But the director or the employee would have to pay income tax as if it was a benefit in kind. So rather than paying a £10,000 dividend, they would pay tax at the normal rates, 20 and 40 or even 45%. But it goes even further than that, because if the company writes off that loan and it's an employee and the revenue say it's been written off in the capacity of an employee, not only is there income tax due, there's also national insurance due on the amount of write-off. I've seen plenty of cases where the revenue will go for it. Now, there are, if you drill down to this, some court cases that will say, well, if a board minute is drawn up saying the reason it was written off was not because they're an employee, not because they're a director, that it was written off because they're a shareholder of the company, that would still be taxed as a dividend on the individual, and so on. I think what you have to say, you're a very brave person if you go down that route. Without having definitive proof, because the revenue's default position will be, we want income tax, we want to have employee and employers NI on that loan write-off. But as I say, the positive side is that the company in that situation could claim a deduction for the write-off in the company accounts. Also to be watched out is what they call unallowable purposes of loans. The write-offs, any debits in the accounts will not be allowed if the revenues say, so this covers interest or write-off of debts, that there was an unallowable purpose. Now, very simply, an unallowable purpose includes a purpose which is not amongst the company's purposes or other commercial purposes. Now, note here, it says includes a purpose which is not amongst the company's purpose or other commercial purposes. So it doesn't have to be the sole reason, it has to be court. So I've used some two examples here. Now, this actually comes from a court case. So Dale Limited is a manufacturing concern based in Yorkshire and exports goods to South America. The company borrows goods in the UK, so it borrows money in the UK to buy a property in London, which houses the buyers from abroad and holds meetings with them. So far, so good, you say. Well, the house is being used for business purposes. The interest payments on the loan are clearly allowable since the loan has been taken out for the purposes of the company's business. I think we'd all agree. However, from time to time, the house is being used by the managing director's son, which is going to university in London. Even though the interest costs have been allowed in the accounts, That must be apportioned between a business and non-business purposes, because the managing director's son going to university using the property, that clearly has nothing to do with the company's trade. So those costs must be apportioned on what is called a just and reasonable basis, and the debits relating to the non-business use of the property would be disallowed. Now, I would add that in some cases, I would argue that there's a benefit in kind and therefore it would be allowable. But you just be aware, the revenue can say, well, actually, the loan has been done for an unallowable purpose. I see it from time to time. Company A borrows money, lends to company B, which goes off and does something completely in regard. Now, if that's the case, the revenue could turn around and say you're not getting an allowance for it. What about a situation where a company lends money to a shareholder and writes it off, and there's no return and there's to issue profit dividends in the period? What the legislation actually says is it doesn't actually talk about dividends per se. What the legislation says is that it is the write-off is treated as if it's a dividend for tax purposes. So you can actually have that bizarre situation where the company is insolvent and it writes off the shareholder's loan in order to continue trading. And although you wouldn't be able to pay a dividend, for tax purposes, it is treated as a dividend. I hope that makes it clear. Sometimes you have to look at the tax and the accounts. And even though there are some cases where you might have to show it as a dividend on the person's tax return, even though you write it off in a slightly different way. Okay, person saying thank you. Thank you very much. Right, moving on to another example. Now, I must admit, I used this example before we had the Ukraine war, so there'd be other issues now with this particular setup. But so, example 2, you have this company that's a UK branch of Zagrov, Grieve or whatever, a non-UK resident Russian holding company. The company uses British banks to fund its global operations. There's a £12 million loan, which is raised from Cash Bank to fund the activities in Guatemala, which is a country which is not surprisingly within the charge of UK corporation tax. The company has no involvement in those activities, but agrees to pay the interest. So what it's saying is, okay, we'll borrow the money, we'll pay the interest on behalf of our overseas operation. Would that be allowable for tax purposes? Well, the revenue would say no, because it is not part of your operations. It would be an unallowable purpose and therefore hence disallowable. So when you look at loan relationships, if you look at write-offs an account, although the starting point, as I say, is you look at the accounts, just remember there can sometimes be an unallowable purpose. So what about connected companies? I mentioned connected companies in the past. So what the legislation says, and this is where it gets complicated, because I've been talking about associated companies and how they are controlled. Now, there's a different definition of control for the purposes of the loan relationship regime. So what it says for loan relationships is a company is connected with another company if the same person has the control of both companies. Now, with associated companies, there's this deeming, this intercommercial dependence test we talked about. None of it here. It's the same person, or the same person has control of one person, and persons connected with it has control of another company. So again, if my wife and myself control one company, and the other company, so basically, if the same person has control of companies, or a person has control of companies, and then somebody else controls connected with A has control, so my husband and wife, that picks up that situation. If you have control of one company and other people control it, or you have a group of 2 more persons together, and they've got similar groups and another. So again, you just have to simply ask the question: who controls company A? Who controls company B? Are they related? If they are, then they can be connected under the purposes of this regime. So again, you look at holding, but rather than associate companies where you look at loans. For connected companies, and the loan relationship regime, you just look at shares and voting powers and so on. What's the consequence if a company is connected for tax purposes? Well, what it means is that the debits and the credits are not allowed or taxed in another company. So, for example, you may have a group company which is lending money to another group company. What it means is that in both companies, the interest is not subject to tax. Neither is the interest allowable for tax purposes. You may have a situation where I control a company and also my wife controls a company. Because we're all linked. Again, the debits and credits are not allowed or taxed in either company. So it's one of the few occasions when you wouldn't allow the tax relief for the interest, and you wouldn't allow or you wouldn't subject the tax received, interest received, to tax in the other company. So there's symmetry. One doesn't get tax relief, the other one doesn't pay tax, but you just need to be aware of that if you're dealing with connected companies. Now, there's also a concept of connected relationships. So we're not looking about, so in this slide, we're talking about connected companies. This slide, we're talking about connected relationships. So who is a connected relationship? Well, basically, it's the debtor. So the person who is lending, who has borrowed the money. Remember that the legislation talks about debtor as the person who's the borrower. It is a close company. So, and the creditor is a participator. So normally what we're talking about is a situation where I, as a shareholder, has lent money to my company. If that is the case, then you're connected. There's a connected relationship. So what might happen is you may put interest through the accounts, but I might say, actually, I tell you what, don't pay that interest to me. So the company may accrue the interest and show it within accruals, but actually it never actually credits it to my director's loan account. It never shows, it never physically pays that across. Now, if you think about it, what's happening? What would happen is, in the absence of this legislation, the company would claim tax relief, and I would never pay tax on that credit. So what the legislation says is, if you have interest claimed in a tax, if you have interest between a connected relationship, basically the shareholder, the person who controls it, then the interest is not allowable for tax purposes unless it is paid across within 12 months of the end of the accounting period. So, in your compliance, just ask yourself the question, if you're in that situation, is the interest being paid across, or has it just been simply accrued? Now, of course, when you do pay the interest across, I would receive, I would be deemed to receive it. I would pay income tax. The company would then be able to claim tax relief on it at that point. So it's not always lost, but it's down to a question. Now, we're moving swiftly into the final sections of this section, and then we'll take a break. I just want to talk, having talked about loan relationships, move and talk about raising finance, just to remind ourselves when we're talking to clients about the differences. So, there's two real ways you can raise finance. One is as loan capital. The benefit is that the company can claim tax relief on the interest that's paid. It's easy to repay. It's easy to give security for a loan. Obviously, you have to have the paperwork, but it's fairly easy to be secured. However, you have to remember that the downside is that the company has to show that loan as a liability on the balance sheet. Sometimes that can cause issues, particularly if you've got other lenders. The individual is unable to claim tax relief for that loan if it is not repaid, because all you'd get is a capital loss, which you could carry forward against other capital gains. But to me, as an individual, that may not necessarily be a very good thing. So loan capital, flexible, easy to set up. Company's good, because you get tax relief on the interest. However, as an individual, there's no tax relief for the loan if it's not repaid. Also, interest, which I haven't put on this slide, in terms of inheritance tax, loan capital in a limited company. So money that a company owes me is a debtor for me as personally, and will be subject to inheritance tax as an asset of my estate if I was to die. So share capital, there's no tax relief for the company because the company would pay dividends, no tax relief. However, as an individual, I may be able to claim income tax loss relief for that loan. So, if I lend £100,000 and the company doesn't repay me, I might be able to, in some situations, claim an income tax deduction of £100,000. Now, there are limits on the amount that you can claim as a loss these days as an individual. So I'm not necessarily saying, that's why I'm saying you may or may not get it. And also that it qualifies for business property relief for inheritance tax purposes, which, particularly if you're a wealthy individual, is something that needs to be covered. So sometimes you have to sit back and say, actually, what's better in a situation? Particularly now with share capital, we're seeing a lot of companies saying, well, actually, okay, actually, they'll go down this route. It keeps the balance sheet looking quite healthy. Not only does it keep the balance sheet quite healthy, these days you can reduce share capital fairly easily. So if you do need to pull that money out quickly, you can sign the solvency statement that says the company is going to continue to go in concern. In terms of raising finance, don't forget about EIS and SEIS. Now, I apologise, I realise this slide is not the easiest to see. But basically, EIS and SEIS are two of the government schemes that were introduced to try and encourage people to lend money into companies. EIS, you only get if £100,000 is advanced to a company and if EIS, then you get 30% tax relief. So you get £30,000 tax relief. I see we've got a question answer. I know the transcript has a full narrative Mark's delivery. Is it possible to download this at the end, please? Truthful answer is I don't know about that. Chris might be able to give you an answer of that. EIS, 30% national, 30% income tax relief when you pay the money in, which means if a company raises £100,000 share capital, and I subscribe for shares in that company, it actually only cost me £70,000. After 3 years, if those shares are sold at a profit, there's no capital gains tax. If I've had capital gains tax in the past, I can defer capital gains. If I make a loss, as I say, you can claim that loss relief against your income tax. And also, after 2 years, you get the inheritance tax savings. SEIS, intended for smaller companies more risky, so there's more benefits. 50% income tax relief for any investment in a SEIS company, and a capital gains tax relief. The capital gains tax reinvestment relief, 50% of the gain disappears altogether. It's not just temporarily parked, it disappears altogether. And loss relief, however, isn't so great on the grounds that you only get 27p and a half pence in the PP. But again, it's subject to inheritance tax reliefs. Who can benefit from these? Well, SEIS are small companies, so fewer than 25 employees. Company has to be trading for less than 2 years. The gross assets must be valued at no more than £200,000, and subject to £150,000 overall limit. And then fewer than 250 employees for EIS rather than 25. Trading for 7 years. Gross assets of £15 million. Now, I mention this because sometimes when we're talking to companies, we forget about these reliefs, particularly if you're going out and raising finance from people outside. They're important things. We set up several of these schemes for our clients. Yes, there is a lot of paperwork involved, but yes, it can be quite a thing. You can almost have a whole session on EIS and SEIS and some of the other fundraising schemes. So the time is 8:03. I think what we'll do is we'll take a breather. If we come back at 8:10, I will then talk about losses and some of the more topical things. Now, the second slides, I will be able to sort of rush through a lot quicker. So if I'm mobile, I'll just take a quick break and we'll be back at 8:10. I hope that's okay with people. Well, welcome back. Thank you very much for everybody who has stayed on this call. Just make sure that the people can hear me. Could somebody please just put something in the chat, sorry, in the question and answers box, just to say that they can hear me. Thank you very much. Thank you. Right. Okay. So I was talking about raising finance, and so the final sort of chunk talks about losses. I talk about losses, and it's because and it's still a bit of a problem area, purely and simply because the rules changed in 2017. Some of you may, depending upon what you've done with your tax software, have actually had a letter from HMRC that says that they will be using the computations submitted rather than the CT 600 entries. And what that's about is that in some cases, some tax software companies have not been completely correctly filling in the CT 600s. Because they overlooked these changes that happened in 2017. I have to say, in every single case that I've seen, it makes no difference. It's just down to the revenue, I think, just trying to make a point. And most tax softwares, again, RS is one of the companies that actually have revamped their software so it correctly fills the boxes in. So what happened in 2017 was that the loss regime was made a lot more flexible. Now, I want to sort of earmark this because although the loss regime was made more flexible, a lot of the tax software companies have not made their software that easy to claim these losses. So I want to cover it off. So basically, if you had a trading loss in a company and the company was acting on a commercial basis and with a view to making profit in the trade itself. So what the revenue is saying is you've got to have a proper business in order to claim any loss relief at all. If you had a trading loss in a given year, you can claim the tax relief in the year that the profit has been made, or carry it against the profits of the previous year. Now, just as a reminder that for the 2 years ending 31st March 22, due to COVID, they relaxed the 1 year carryback rule to 3 years carryback. And I know that where we've done 3 year carryback claims, the revenue have actually processed them very quickly, a lot quicker than 1 year carrybacks. I'm told by a call with the revenue this morning that it's taking about 2 months for a 1 year carryback claim to be even looked at. So allow time if you're talking to your clients. But the trading loss can be carried forward until the trade finishes. And that's an important note that if you've got a company that has been trading and profitably starts making a loss, winds down that business, the trading loss can be carried forward until that trade finishes. And what can happen about that carry forward? Well, you can claim it against any of the profits going forward. So if there's a rental property in there, those trading profits can be offset against the property income while that trade exists. And the minute that trade finishes, then their losses are lost. But just watch out for if the company is sold. If the shares of the company are sold and there's a change of control and a change in the way that the trade has been conducted, then there's a 6-year rule that says that if both those things occur in a 6-year period, then those trading losses cannot be claimed going forward. And if the trade comes to an end, then you can actually claim back the losses against the earlier trading profits on a 3-year carryback regime. Something that very often gets overlooked. People get so used to locked into the 1 year carryback, they forget that you can carry back 3 years if the trade ceases. What about property losses? Well, it used to be property losses can only be carried against property profits. From 2017, property losses can be carried against the same year profits, and that includes all profits. So that's all profits in the company can be carried forward, not against future property profits, but also against future trading income, total profits, capital gains. So they're very, very flexible. And remember, if it's a furnished holiday let, it's actually treated as a trade loss. So the message here is property losses can be allowed in the same way. There's no carryback, but they can be carried forward in the future years. What about loan relationship losses? We've been talking about them earlier on. If you have a loan relationship loss, you can carry it backwards against loan relationship profits in the previous 12 months, or carry it forward. And again, the carry forward isn't just against future low profits on a loan relationship, it's against total profits, trading profits, property profits. And this is the point that I think the software companies were missing, that the carry forward of losses from 2017 can be carried forward and used against any type of income, not just the type of income which gave rise to the loss in the first place. Also, group relief. Just remember that if you're in a group, you can move groups around the group. However, just also remember that loss reliefs carried forward is limited to 5 million. That doesn't sound a lot, but if you've got a large group that you're dealing with and you're just dealing with one part of it, just ask the question, what's the rest of the size of the group like? Because if there's losses of £5 million in 1 year, then you can actually find that the losses are limited. And also a group company would have to actually fill in what's a statement to say, this is how we're allocating the £5 million balance across the group. So that's a bit about losses. Just some topical things. Just going to the budget that we had, I just want to say something very quickly about this expensing capital expenses. Jeremy Hunt got very excited during his talk about saying that from now on, companies will be able to expense capital expenses. Well, what does that actually mean? Well, first of all, just a reminder, it only applies to companies. When he was talking about it, it made it sound like it applied to everybody, but it only applies to companies. What it means is that you can have 100% relief on new assets with no limit whatsoever. If you're spending money on integral features, things like electricity, plumbing, and so on, then there's only 50% relief allowed for it. But you can't get it. This new regime doesn't apply to cars, assets. But when you sell the asset, just because you claim the capital expenses, you can also get taxed on it. But remember that the annual investment allowance remains at £1 million. So actually it means for most of the companies that you and me deal with, actually will be claiming the annual investment allowance. So the big announcements that they had is only of great use to somebody whose company is spending more than £1 million in 1 year on assets. What was also quite silent is just a reminder that if a company is putting an electric charging point, there's 100% writing off allowance on the electric charging point equipment. It was due to run out, but it will last until 31st of March 25 until 5th of April 2025 for tax purposes. And then the final slides, I want to talk about research and development. Research and development is an area that has been subject to a lot of abuse. In fact, last year, HMRC put all reclaims on hold for about 2 months because they had to whittle out fraudulent claims that had been put in. So there's going to be lots of changes. Now, at the moment, there's 2 schemes. There's the small, medium-sized enterprise scheme, and there's also the large company scheme. And there's going to be an announcement in the summer about how these 2 schemes will be merged. Now, if I was a betting man, I'd be saying that actually they will bring these schemes into one, but it won't be until April 25. Some commentators say April 24. I think that's going to be a bit quick because I think there needs to be a way that you can bring these 2 schemes together. But what happens now? So from the 1st of April 23 up to April 23, a small business could claim tax relief on 130% of its research and development expenditure. So if you had an employee salary of £100,000 and they worked exclusively in R&D, you could claim the £150,000 salary, but also you could claim £130,000 on top as a tax deduction, which is quite valuable if you think about it. Well, that 130% is dropping down to 86% from 1st of April 23. If the company was making a loss, you wouldn't be able to get any benefit from it, and you could surrender that loss in return for into tax payments. Underneath the old regime, the repayment was 14.5%. So if you had £100,000 worth of losses due to an R&D claim, you would be able to claim £14,500 in cash and surrender the loss. From 1st of April 23, that drops to 10%, so £10,000 in that case. But there was this loss-making intensive thing. So if you are spending 40% more of your spend on R&D, your credit stays at 14.5%. The large company scheme, that is also changing. In fact, that can be made to be more benefit. The credit that you get was 13%, is now 20%. So if you actually look on paper, what they're trying to do is the small, medium-sized R&D system is getting less better all the time. The larger one is getting better, and I suspect that what will happen is they'll between the two systems into one equilibrium, and that's the point where we'll have one company. That's why I think it will be sort of April 24, another change like this, and then perhaps April 25, where they bring the two schemes together. You can now claim the cost of data sets and cloud computing. I will not confess that I do not understand what the cost of data sets are. Cloud computing, doing research in the cloud, you can now claim the tax relief on it. But what is more important, I think, is just also, as well as those things, just to remind you about something that came out 1st of April 23, the Review published this. So from the 1st of April 23, you will have to notify HMRC if you intend to make an R&D claim. And that's the page on their website if you want to go and read all about it. So you've got to tell the revenue if you want to make a claim ahead of making the claim. So it applies to accounting periods beginning on or after the 1st of April 23. When do you have to notify them? If you're claiming for the first time. If you claim for the previous tax year, but you didn't submit that claim until the last day of the notification period, which was 6 months after the end of the period, or if your last claim was more than 3 years before the last date of the claim notification period. So the message here is it's going to stop clients phoning you up 9 months after the accounting period saying, that CT 600 you just put in for me, actually I'm going to claim R&D tax relief. No, they're going to have to notify them 6 months after, or if you can do it beforehand, but up to 6 months after the end of the accounting period. But also, on top of that, the revenue will want more information. So for any R&D claim submitted to the revenue from the 1st of August 23, now I would talk about this in the office, and I suspect there will be a whole rush of people rushing their claims through so they don't have to provide this additional information. So if you deal with corporate tax, expect us to get a whole rush of people 31st of July. I wouldn't take your holiday during July. So what additional information will you need? Well, to start off with, from the 1st of August 23, as well as claiming the R&D relief on your corporate tax return, you will have to submit to HMRC and a report. The report will be online. They'll be using a revenue form, and it will have to give specific information about the company's R&D activities. So I'll have to give details of the costs incurred. It'll have to identify any agent that's advised on the claim. It will have to say what employee or officer is responsible for the claim. So you'll have to find somebody in your client will have to sign it off. And also, as I say, you've got to notify it ahead. Now, we haven't got time to go into too much detail, but what they're saying is that if you've got a small number of projects, you've got to provide the additional information for 100% of the qualifying profits, and then the number of projects you're dealing with would then the full information goes down. So what additional information? Well, you'll have to say for each project what is the main field of science or technology that it deals with. What was the advancement? What were you trying to advance? What was you trying to gain? What advance did the company aim to achieve? What was the uncertainties you were trying to overcome? And how did your project seek to overcome those uncertainties? On the face of it, you think that actually that's 5 very simple things, but actually it's going to take a lot of time and effort sitting down with clients. I had a client I had a phone call with this morning, always made a claim, and they identified 20 projects that they're going to have to actually tell the revenue about and provide this information for each one of those projects. Also, just as a reminder that the audiovisual industry will also be able to claim various claims. So we've come to the end. I promised I would try and finish by 8:30, so I'll finish a little bit early. Thank you very much for everybody who has actually hung on to this. You'll see here on the slide my email address. You can write it down, mark@walterwright.co.uk. Please send me an email if you've got anything that you want to talk about after this. And I will hand back over to I'm looking to see who it's going to be. I'll hand back over, just for the time to be finished. So thank you very much. Thank you for the time, and thank you very much for hanging around.
Thank you very much, Mark.
Hello, Florence.
Yeah, hi. Thank you so much. The presentation is very, very detailed. And for everyone, thank you very much for attending. And as Chris already told us, he's going to send the whole slide to Chris, and Chris will send it in a distributed round, because the information are very detailed. So we all need to go back and start looking at it and use it in our computation of corporation tax. Thank you so much. And just to let everybody know, those who attend tonight, that Milton Keynes and Bedford event, the next event is going to be on the 14th of June, and it's going to be face-to-face at Holiday Inn, Milton Keynes East, M1 Junction 14, MK16 OJA. The topic is going to be communicating financial information. And the same day, we're going to have our AGM. But the special news there is that our AAT president is going to be there as well. Please, if you are here to register, go in and register, and we look forward to seeing everybody. Thank you very much for tonight. Thank you, Mark. Thank you, Chris, for hosting events. Yes.
Thanks, everyone.
Thank you. Bye.
Bye.